Is this the bottom? That's what we asked last week, and finally we might have some answers this week. We'll also look into whether RBI's latest moves are sufficient to boost India's GDP and dive into the intriguing story of foreign investors. All this in this week's episode of The Week That Was, where we round up all the big events from the week and tell you how it impacts your money. As always, we start off with the markets. Last week we spoke about green shoots. Well, those shoots are growing. The December cool seems to have brought more stability to the markets and more cheer as well. Both Sensex and Nifty were up on 4 consecutive days before ending the week almost flat. Both the indices were up 2.5% this week. They are now just 7% off their all-time high. So, how come this sudden change in sentiment? Especially when our quarterly GDP has dropped to 5.4% and our inflation has spiked to 6.2%. The answer is, surprise, surprise, foreign investors. Foreign institutional investors have turned buyers and have pumped in over 10,000 crores this week. While this number might be very small compared to the $15 billion they've withdrawn over the last 50 days, the dynamics have changed. Remember, the domestic investors have been bullish and have been pumping money into the markets month over month. Now that the FIIs have joined forces with domestic investors, the markets are bound to go up. In spite of the change in momentum, we continue to maintain our stance that the markets will be range-bound. The economic headwinds will cap the upside, where the continuous inflow of money from domestic investors will protect the downside. Moving on to our first story of the week, the curious case of foreign investors. Here's an anecdote. Back in 2008, that's during the financial crisis, foreign investors pulled out over $15 billion from the Indian equity markets. The result, our markets fell by 60%. You heard it right, a correction of 60%. In the last 2 months, the foreign investors have pulled an equal quantum of money, that is about $15 billion. Yet, our markets have corrected only by 10%. What has changed over the last 15 years? Reason number 1. Back in 2018, our total market cap was $1 trillion. That is, if you summed up the value of all listed entities or stocks, the total value was $1 trillion. Today, our market cap stands at $5 trillion, as a result of which a $15 billion pullout has a smaller impact. 2. The rise of domestic investors. Back in the day, foreign investors held over 25% of the Indian equity market. Over the last 15 years, that number has been falling, and today it stands at 16% of the total market cap. Domestic investors, which include mutual fund, retail investors, and pensions funds, have stepped up. In fact, domestic investors' holding have surpassed that of foreign investors, marking a significant shift. This is a proud moment. This is our market, and we are taking ownership and control of it. These 2 reasons have brought more stability to our markets and reduced the volatility and shielded us from the fickle-minded foreign investors. Our second story for the week is RBI's action to boost growth. Last week we spoke about the importance of RBI's intervention to keep India's growth story alive and thriving. The quarterly GDP number of 5.4% had surprised everybody and had significantly fallen short of RBI's own projection at 7%. This week, RBI did intervene. We were expecting an interest rate cut, but that didn't come. However, RBI has reduced the cash reserve ratio, that is CRR, by 50 basis points. The cash reserve ratio or the CRR is applicable to all banks. This is the percentage of the total deposit that the banks hold with RBI as a reserve. This reserve is held in liquid cash and does not earn anything for the bank. By reducing the cash reserve ratio from 4.5% to 4%, RBI has freed up 1.16 lakh crores into the banking system. Banks can use this extra liquidity to lend more to corporates, businesses and individuals, and potentially spurring up economic growth. They can also pass the benefit to existing borrowers by cutting interest rates, thereby making loans more affordable and putting more money in the hands of borrowers, thus helping consumption. This is a very good move by RBI. Cutting CRR will have an immediate impact on the economy. Interest rate cuts usually have a delayed impact. However, we strongly believe that RBI will be forced to cut interest rate in the next quarter. RBI has lowered India's GDP growth for this financial year from 7.2% to 6.6%, while rising the inflation number from 4.5% to 4.8%. These are strong economic headwinds that will limit the growth of this market in the short term. On that note, we come to another episode of the week that was. Don't forget to like, share and subscribe. If there are any topics that you would like to cover, do write to me at ajat@fabits.com. Standard disclaimers. This is not investment advice. Views are personal. I or customers of Fabits might hold assets discussed in this video. Investments in equity markets are subject to market risk. Please read all necessary documents before investing.